What if the biggest shift in American ownership didn't happen through force, laws, or confiscation, but through spreadsheets, retirement accounts, and index funds you already own? That's the question more Americans are starting to ask. And it's why BlackRock's name keeps appearing at the center of a growing economic debate. This is Financial Freedom Desk, and in the next few minutes, we're not going to deal in rumors or fear. We're going to deal in structure, incentives, and facts that most people never see clearly laid out. Before we go any further, take a second to like this video and subscribe to the channel. It helps more people see economic analysis that doesn't fit into sound bites, and it keeps this kind of breakdown alive on your feed. Now let's begin. BlackRock is not a shadow organization. It doesn't hide. It doesn't operate in secret. In fact, that's exactly what makes the story so uncomfortable. Everything is happening in plain sight, and still, most people don't understand it. So, BlackRock is the world's largest asset manager, not a bank, not a hedge fund, an asset manager. That distinction matters. BlackRock doesn't technically own the trillions of dollars it oversees. It manages money on behalf of others: pension funds, retirement accounts, governments, institutions, and everyday investors. So why do people say BlackRock owns everything? Because ownership in modern capitalism no longer looks like it used to. In the past, ownership meant control, decision-making, and accountability. Today, ownership often means exposure, while control concentrates elsewhere. When millions of Americans invest through index funds and ETFs, they gain market exposure, but they surrender voting power to fund managers who act on their behalf. And when one firm manages an enormous percentage of those funds, influence consolidates, even if intentions are benign. This is where perception turns into anxiety. BlackRock, through index funds, holds significant stakes in thousands of companies across nearly every sector. Not because it chose winners, but because passive investing requires owning everything in proportion to the market. Efficiency drove scale, scale created influence, influence created concern. The question isn't whether BlackRock plotted this outcome. The real question is whether the system itself produced it. And that's a much harder conversation. Americans are feeling something slip away. Home ownership feels harder. Stock market gains feel distant. Corporate decisions feel disconnected from public interest. And when people search for explanations, they find one name everywhere. BlackRock becomes a symbol, but symbols can obscure reality as much as they reveal it. At Financial Freedom Desk, our job isn't to tell you who to blame, it's to explain how the machine works. Because if you don't understand the machine, you can't decide whether it's broken, rigged, or simply misunderstood. The truth is, modern financial markets reward consolidation, passive investing rewards scale, regulation favors large institutions that can absorb compliance costs, and over time, these forces quietly reshape ownership without ever announcing a revolution. No press conference, no decree, just quarterly inflows. This is not a story about villains in a room. It's a story about incentives doing what incentives always do. And once ownership becomes abstract, once it's mediated through layers of funds, custodians, and algorithms, people begin to feel disconnected from the economy they supposedly own. That feeling is real, even if the conspiracy isn't. The danger isn't that BlackRock controls America. The danger is that Americans no longer understand who controls what and why. BlackRock votes on shareholder resolutions, executive compensation packages, mergers, board appointments, and governance policies. Not because it wants to control companies, but because someone has to vote. And when millions of investors outsource that role, voting power concentrates by default. This isn't unique to BlackRock. Vanguard and State Street operate under the same model. Together, the big three hold substantial voting influence across corporate America. Not because of coordination, not because of collusion, but because passive investing centralizes representation. This is where discomfort sets in. Most Americans believe they own stocks through retirement accounts, but very few realize they've delegated their voice. When corporate decisions feel disconnected from public interest, people instinctively look for intentional control. But what they're seeing is structural concentration, not secret command. And yet the effect feels the same when a small number of asset managers vote on behalf of millions. Their internal policies matter enormously. How they interpret fiduciary duty, how they weigh long-term risk, how they engage with management. These decisions ripple across the economy quietly, consistently, and without public visibility. BlackRock has tried to respond by offering pass-through voting options to large institutional clients, allowing them to direct votes themselves. But for the average investor, that choice doesn't exist. Convenience still wins. This raises a difficult question that has nothing to do with conspiracy and everything to do with governance. Can a system built for efficiency also preserve democratic ownership? Because when ownership becomes passive, accountability becomes abstract, and when accountability fades, suspicion grows. The irony is that BlackRock's influence is a byproduct of investor behavior. People wanted markets without thinking, returns without decisions, growth without responsibility. The moment this debate stops being theoretical is when it leaves financial markets and enters daily life. Because ownership isn't just about stocks on a screen. It's about homes, roads, utilities, energy systems, and the assets people interact with every single day. And this is where the discomfort around firms like BlackRock becomes tangible. BlackRock didn't invent this shift. It facilitated it through real estate funds, infrastructure vehicles, and private market products. BlackRock acts as a conduit between global capital and physical assets. The money often comes from pensions in Europe, retirement funds in Asia, or endowments in North America. BlackRock structures the deal, manages the asset, and collects a fee. But from the outside, what people see is simpler and more unsettling. They see homes being bought in bulk. They see rents rising faster than wages. They see local ownership disappearing and being replaced by faceless entities with global balance sheets. And they ask a reasonable question: who owns this country now? The truth is complicated. In most cases, BlackRock itself does not own these assets on its balance sheet. The funds it manages do, and those funds represent millions of beneficiaries: teachers, firefighters, retirees. But perception doesn't care about legal nuance. When decision-making is distant, ownership feels lost. And this is where the psychological shift happens. Historically, ownership implied proximity. You knew who owned the building, you knew the landlord, you could vote out local officials who approved zoning. Power had a face. Today, ownership is layered, abstracted, and intermediated. Decisions are made through investment committees, algorithms, and return targets defined thousands of miles away. Nothing illegal, nothing secret, but deeply alienating. Housing illustrates this better than any chart ever could. When institutional investors enter housing markets, they don't behave like families. They don't negotiate emotionally. They price risk statistically. They optimize rents. They standardize management individually. Each decision is rational. Collectively, they reshape markets. And when people feel priced out of stability, when home ownership slips further out of reach, they don't blame interest rates or global capital flows. They blame the entities they can see. That's how firms like BlackRock become symbols. Not villains by design, but lightning rods by position. The same dynamic plays out in infrastructure. Toll roads, airports, ports, power grids. These assets increasingly sit inside investment vehicles designed for yield. Governments, strapped for cash, sell or lease them. Investors step in, efficiency improves, but control feels distant. And distance breeds distrust. Here's the uncomfortable reality no one likes to say out loud. Modern economies require more capital than local ownership alone can provide. Pensions depend on returns, aging populations need income, and infrastructure is expensive. Someone has to fund it. And in a globalized financial system, capital doesn't respect borders or nostalgia. But that doesn't mean the concerns are invalid, because when ownership becomes financialized, the social contract weakens. The incentives of capital don't always align with the lived experience of communities. And when the gap grows wide enough, people stop asking how the system works and start asking who it works for. This is the tension at the heart of the BlackRock debate. Not a conspiracy to end American ownership, but a transformation in how ownership functions in a global economy. One that happened gradually, quietly, and without public consent. This is where the conversation becomes uncomfortable, because it touches the one boundary modern democracies pretend is solid, but increasingly feels porous: the line between financial power and political influence. BlackRock does not pass laws. It does not vote in elections. It does not issue executive orders. And yet, its fingerprints appear across policy discussions in ways that are hard to ignore. Start with the revolving door. Senior figures move between government, central banks, and major financial institutions with remarkable ease. Former regulators become advisors. Former executives step into public roles during crises. This isn't unique to BlackRock, but its scale magnifies the effect. When a firm manages trillions, its expertise becomes indispensable. And when expertise becomes indispensable, influence follows. During moments of stress, this relationship becomes most visible. In the aftermath of the 2008 financial crisis, governments learned a harsh lesson. They lacked the tools, data, and infrastructure to stabilize markets on their own. In later crises, rather than building those capabilities internally, they outsourced them. Asset purchases, emergency facilities, market backstops, many were executed with the help of firms that already had the systems in place. BlackRock's Aladdin platform, originally built for risk management, became a tool governments leaned on, not because of conspiracy, but because of convenience and speed. When markets freeze, there's no time to design new systems. You use what already works. But here's the issue no one likes to confront. When private institutions become embedded in public crisis management, neutrality becomes fragile. Even if decisions are made in good faith, perception matters, and to the public. It looks like the same firms advising governments are also positioned to benefit from the outcomes. That perception erodes trust. Add to this the rise of stakeholder capitalism and ESG frameworks. BlackRock didn't invent these ideas, but it championed them loudly. Letters to CEOs emphasized climate risk, social responsibility, and governance standards. Supporters saw leadership, critics saw pressure. The deeper concern wasn't about sustainability, it was about authority. Who decides what responsible investing means? Who sets the standards? Who enforces them? When a firm with trillions under management signals a preference, markets listen, boards listen, executives adjust, not because they're forced, but because capital flows follow incentives. This is power without a ballot, and unlike elected officials, asset managers aren't accountable to voters, they're accountable to clients. That distinction matters, because public policy is supposed to reflect social priorities, not portfolio construction. Yet the two increasingly overlap. Climate policy affects asset values, housing policy affects returns, energy transitions reshape markets. When financial firms engage with these issues, they aren't neutral observers, they're stakeholders. Again, nothing illegal, nothing secret, but the system wasn't designed for institutions this large. Democracies evolved when power was fragmented. Markets evolved when capital was dispersed. Today, capital is concentrated, mobile, and hyper-informed, and governments, often slower and constrained, find themselves reacting rather than leading. This creates a feedback loop. Governments consult financial institutions for insight. Markets adjust based on policy signals. Firms that understand both worlds gain an advantage. Over time, influence becomes structural, not intentional. And that anger doesn't target abstract systems, it targets names. In the final part, we'll confront the question that matters most. Is this trajectory reversible, or has modern capitalism crossed a threshold where ownership, influence, and democracy can no longer be separated? Every economic system preaches moments where small adjustments no longer work, where reforms feel symbolic rather than structural. This may be one of those moments, not because a single firm has grown too large, but because the architecture of modern capitalism now depends on concentration to function at scale. The uncomfortable truth is that undoing this trajectory is far more complex than identifying it. The first illusion to discard is the idea that breaking up large asset managers would automatically restore balance. Capital would not suddenly disperse back to households. Pension funds, insurance pools, and sovereign wealth funds would still need centralized management. Risk would still demand scale. Technology would still reward size. The machine would rebuild itself, perhaps under different names, but with similar gravitational pull. That doesn't mean the outcome is inevitable, but it does mean the solution is not simple. The real leverage point lies in ownership, transparency, and governance reform. If asset managers vote on behalf of millions, then the structure of that voting power matters. Who gives instructions? Who can override them? Who is accountable when decisions affect entire communities? These questions are still unresolved, and markets move faster than lawmakers in defining them. Rebalancing that dynamic requires policy courage, not rhetoric. There is also a deeper cultural shift underway that rarely gets discussed. Younger generations increasingly distrust financial intermediaries altogether. They favor direct ownership, decentralized systems, alternative assets, and platforms that promise control rather than delegation. Whether these systems fully succeed is uncertain, but the direction is clear. People are no longer comfortable outsourcing everything, especially power. That matters because legitimacy is the foundation of any economic system. When legitimacy erodes, compliance follows, slowly at first, then suddenly. What the story ultimately forces us to confront is not a single firm, a single policy, or even a single moment in time, but a structural shift that has been building quietly for decades. Ownership, power, and decision-making have migrated away from individuals and communities into systems designed for efficiency, scale, and insulation from accountability. This did not happen through a grand conspiracy or a sudden takeover. It happened through incentives, convenience, and the steady normalization of surrendering control in exchange for stability. And that is what makes it so difficult to see, because nothing was ever announced. History teaches us that societies don't usually collapse when people are warned. They fracture when people stop feeling connected to outcomes, when ownership becomes abstract, when risk is socialized but rewards remain concentrated, and when participation feels symbolic rather than real. Trust erodes long before markets do. The danger ahead is not only financial instability, but civic disengagement, the quiet acceptance that the future is something managed by others somewhere else. Yet transitions are not destiny. Systems designed by people can be redesigned by people, but only once they are understood. Transparency matters, decentralization matters, accountability matters. If this analysis raised questions for you, that's the point. If it made you uncomfortable, that's often the first sign you're paying attention. Share this with someone who still believes these shifts don't affect them. Leave your thoughts in the comments, because discussion is the first step toward reclaiming agency. And if you want to keep breaking down the forces shaping your financial future, stay connected with Financial Freedom Desk. The most important transitions are rarely the loudest ones, and missing them is the real risk.